Hey everyone, this is Cary Baronian from Heritage. I'm excited to be joined today by a very talented individual who I'm lucky to call a teammate and friend, Kaitlyn Kocuba. Caitlin, thanks for getting behind the mic with me this morning.
Yeah, Carrie, happy to be here. Happy to do this.
Awesome. It's funny, we've been working together all these years, but I don't think we've ever slowed down long enough to give this a try. I guess better late than never, right?
I know. And the geographic locations where we sit probably play a role in that too.
Yeah, exactly. I'm already smiling at the thought of giving folks a peek into our conversations. Hopefully we aren't the only ones who find us entertaining. I guess we'll find out soon enough.
Yeah, we've always said we deserve a podcast anyway.
Yeah, this is our shot, our
There we
time to
go.
shine. How about we start with some quick introductions for our listeners? You want to go first?
Absolutely. My name is Kaitlyn Kocuba. I am our Director of Portfolio Management and Operations here at Heritage. I have been with the firm a little over 4 years now, which is crazy to think about because it feels like a lifetime. But 4 years certainly has been a great period of time. Been in the industry a little over 10 years. And as I mentioned in the top of the call, sit in our Pittsburgh office. So, geographically, a little bit different than Carrie, but get to work really closely with her on the investment team and oversee our portfolio management and trading department.
That's excellent. And as for myself, Cary Baronian, I'm a partner and managing director on the investment team here at Heritage. I've been with the firm 10 years and coming up on 2 decades in the industry. It's gone by quickly. In terms of my role, I focus really on all things investment related across the platform, whether it be formation of market views to portfolio construction to focus on managers and individual securities going into the portfolio. And then one of my favorite parts of my role, as you know, Caitlin, is collaborating with you and your team on how that investment strategy functionally ends up in the specific client portfolios. We know that all of the investment research is incredibly important, everything that goes into the formation of those market views and portfolio positioning. I'm equally as passionate, if not more passionate about the portfolio management space, as you know. There's so much that we can't control in these markets, whether markets go up and down, et cetera, but there is so much that we can control to create tangible value for clients, and a lot of that shows up in the portfolio management space, as you know, whether it be the threshold-based rebalancing, tax loss harvesting, asset location, being thoughtful in terms of how we help clients make charitable donations with securities in their portfolio. There's just so many different things that we can do and we do in a disciplined manner to create value for clients. And so I was hopeful in this conversation to be able to unpack some of those things with you and kind of give listeners a peek into what you and your team focus on to create an excellent client experience.
Yeah, I'm looking forward to it. It's funny when you sit down with a client, it's so often that they want to talk about what's the hot stock in the news or what's top of mind for our research team that we're looking into that's so interesting. But some of these things are just so tangible in terms of how they provide, call it alpha in the portfolio or just that better performance and value. You really do essentially get a leg up whenever you add in tax savings to a portfolio or you add in just some of these really dynamic ways that you can trade it to just create that extra little layer of value on top of the really robust investment research that the team is doing. So excited to dive into some of the details and think about particularly how we go into the end of a calendar year with some of these strategies.
Yeah, that's a great segue. Actually, was going to be my first question for you. Only a couple weeks left to close out 2025. What's top of mind for you and your team?
I think when we think about the end of the year, the biggest thing that comes to mind for us is, you've had the entirety of the calendar year to really play around with the portfolio and how that impacts things like capital gains that were realized in the portfolio over the course of the year. So coming into the end, you're really just tweaking around the edges to see like what can I do in these last couple months of the year to solidify that tax plan, whether that be looking for things like tax loss harvesting embedded in the portfolio that may have changed since earlier in the year, or anticipating capital gain payouts from large mutual funds and how you coordinate around some of those for the tax plan, those really become the critical parts. And then the last piece is really just having that tight review of each portfolio coming into the end of the year and even planning for January to say, okay, I feel like my tax plan's pretty baked for this year, but what can I do as soon as the calendar year flips over to take advantage of this strong market performance that we've seen over the last few years, but also get to be really tax efficient with the calendar?
Yeah, definitely. And with the punchline being everything that we do with the investment strategy and the portfolio management is is driven towards trying to drive the best outcomes for clients on an after-tax net of fee basis. You just mentioned that it has been an incredibly strong period of performance for broad equity markets. We're really pleased that our client portfolios have participated in a meaningful way. You also mentioned capital gain a moment ago. Do you want to dive into that a little bit in terms of your thinking on capital gain? Actually, in a conversation we were in the other day, I heard you say something that I thought was pretty clever, and I mean spot on. That sometimes it can really pay to pay capital gain.
Yeah, yeah, and I think there's kinda 2 sides to capital gains, right? Like, there is the capital gains that we take over the course of a normal rebalancing throughout the year within a portfolio, or maybe we're planning for a large cash need for a client. There's a distribution coming up, and we're trying to be really strategic about where we take things from. Or perhaps it's a part of our model trading to get the investments where we want them to from a philosophical standpoint that our investment team is really has a lot of conviction in these days. The second part of capital gains, which I think we'll dive into in a few minutes, is the payouts that come from some of our partners in the funds that we use too. But I find there's just like this one really interesting example that our folks over on the tax team have just really enjoyed since we've been highlighting it as something that's happened in 2025 that might just be timely to take our clients through as an example. So, most of our clients that have been in the portfolio for quite some time know that a particular stock, United Healthcare, was a part of our core equity strategy for several years leading into 2025. We got to participate as that equity came up over the course of those years. And what that meant was some large embedded capital gains in those positions in client accounts. Thinking back to some of our conversations with the research team in January and February of this year, we started to have some reduced conviction in where United Healthcare was going from here. And that reduced conviction really gave us pause to say, okay, we know it's been a strong performer in the portfolio, which means embedded capital gains. And so the where the art of this conversation kind of comes in is the research team decided United Healthcare is not right for our core equity strategy anymore. It's a position we want to get out of. But what is our level of conviction in that position versus the capital gains tax that folks are going to have to pay to be able to get out of it? And we said at the time, we've got a lot of conviction that United Healthcare is not in a good spot. They've got some legislative headwinds and things on the forefront that really are going to add some challenges to where the stock goes from here. And so this is where that kind of nuance comes into play to say, what is the level then of the tax that we feel comfortable with our clients paying to be able to get out of this from an investment standpoint? And so back in February, to give everyone a little bit of the history, we decided to sell United Healthcare across the client platform. And we looked at some of the capital gains that would be affected as a result. And to give one example, and I'll use a little bit more even dollar terms to make the math simple, this client had about $250,000 in United Healthcare with about $100,000 of an unrealized capital gain. And so the team sat down and said, what does it feel comfortable paying in capital gains tax to then go ahead and sell that position? And when we look at the size of our portfolios, that's really where we make that determination. If we say we have a $10 million portfolio, we might say that anywhere in the 2 to 3% of that portfolio range in capital gains tax feels appropriate for our investment strategy to take hold. And so when we looked at that with this specific client in mind, we said, yes, absolutely. Our investment conviction and United Healthcare deems this to be an appropriate time to pay that capital gains tax. And so we sold the position at about $250,000 back in February. And what that meant was that $100,000 in capital gains, if we assume the highest tax rate, that client was paying about $24,000 in capital gains tax for that trade. I took a look at it a couple weeks ago to just see how it played out for that client. And that $250,000 position, should we have not sold it back in February, would be worth about $170,000 today. So an $80,000 reduction in the value of the stock that they hold, worth it in spades to pay that capital gains tax. And so we don't have a perfect crystal ball on this every single time, but this is just a great example of when it really paid to pay that capital gains tax.
Yeah, it was a pretty powerful strategy as you just laid out for folks. And then over the course of the year, we were able to tax loss harvest some other positions in the portfolio, generating losses that helped offset some of that capital gain generated earlier in the year. So pretty good stuff. Caitlin, you mentioned earlier that the kind of the second piece of capital gain conversation being capital gain distributions, which would be typically related to mutual funds. I'd love for you to dive into that. Maybe before you start, you could just give some kind of color about what capital gain distributions are. I suspect some folks might not have as much familiarity with those.
Yeah, yeah, absolutely. And it's funny because mutual funds, in the grand scheme of things, make up a very small portion of our overall portfolios as a whole, but they're a great tool when we feel like there's a space that we could leverage things like active management and depth of research of some of the partners that we work with. And what these capital gain payouts are is when you have these actively managed mutual funds where we are looking at a particular area of the market and we feel these mutual fund managers can add some additional benefit. They may have to trade the portfolio over the course of the year to add those benefits, the same way we're talking about trading our portfolio to add some of these benefits as well. And what that does is those trades in the portfolio create embedded capital gains in the mutual funds themselves that then get passed through to the clients at the end of the year in a capital gain distribution, sometimes mid year too, but the year end ones tend to be the big ones. And so one of our mutual funds that we utilize in the portfolio announced a pretty sizable capital gain, which, thinking about the strong market performance over the last few years, certainly makes sense when we think about what the fund company had to do to have strong performance itself in its fund. But there's some strategies that we can do to minimize some of the tax impact of those large capital gains that come through at year end from these mutual funds. One of the easiest things you can do is as soon as you know that there is a large capital gain coming out, you put a do not buy restriction on that mutual fund. Because the last thing you want to do is buy it here in the weeks leading up to the capital gain payout, then get hit with a large capital gain in a matter of a couple of weeks on a position that you've held for such a short period of time. You just say, hey, I'll wait until after the capital gain pays out. I'll see that NAV, net asset value of the mutual fund, come down on the back end of the capital gain payout, and we'll purchase it then on the client's behalf. The second strategy you can do ahead of some of these payouts is look for people to use real numbers. Again, this mutual fund is going to be paying out about a 13% capital gain. So look at folks that have tax lots in this fund, so individual purchases in this mutual fund with less than that 13% capital gain, because then it makes perfect sense to sell those individual tax lots in their taxable accounts, take the lesser of the capital gains to exit the position just a day or so before the capital gain payout, and then re enter right after that capital gain is issued to avoid some of those unintended tax consequences. And so that's something the trading and portfolio management team here at the firm is going to be doing over the course of the next couple of weeks.
Wow, another really powerful, thoughtful strategy. And I would just add to it, before all of that work that you design, Caitlin, like in the build out of the specific client portfolio, you and your team are really thoughtful about asset location, right? So what's one thing that you try to do off the bat to even avoid doing this type of work?
Yeah, that's a great question. The best part about looking at this capital gain payout was when I pulled up all the client accounts, I got to remove all of the ones that were sitting in Roths,
Exactly.
IRAs, all of these retirement accounts, because these capital gain payouts don't have tax impact for those retirement accounts. And that's something the team takes into consideration when we're initially investing in these funds. When we talk about asset location, there is a concept of tax efficiency that we take into consideration when we're looking at all the different positions within the portfolio. And whatever position is the least tax efficient and a mutual fund that pays capital gains is very tax inefficient, that should be focused in the retirement accounts for our clients wherever possible. Now, there are times when the retirement accounts aren't quite sizable enough to have the entirety of the fund in it, and we may have to hold it in a taxable account as well. And that's where the team begins looking at some of those things. But wherever possible, we try to locate those assets in the retirement account to avoid the tax involved with these capital gain payouts.
That's really good stuff. One other topic on the portfolio management front, before we wrap up, with it being year end, obviously charitable giving is top of mind for clients. Do you want to take folks through just kind of the strategy employed in terms of how the team facilitates those gifts in a way that benefits the end organization as well as drives the best outcome within their portfolio and financial plan?
Absolutely. Charitable giving can be such a dynamic way to look at a portfolio and create some true benefit from a tax standpoint. There's all these different parts of your investment portfolio that end up generating some sort of tax consequence, whether it be capital gains that we've been talking a lot about, or even ordinary income from the distributions from those retirement accounts. They all can create these tax outcomes as you need your portfolio to sustain in things like retirement. And so when the team is looking at how do I reduce some of that tax impact, we're really thoughtful with some of our charitable strategies, as most of our clients are very philanthropic in nature anyway. And so we say to them, we want to take that philanthropic nature that they have and just employ some really thoughtful strategies so that they can both give to these charities that are very meaningful to them, but also save some extra funds in the form of tax savings and portfolio management in terms of how we can take some of the positions in their portfolio to employ those tax strategies. One that I always love to do with some folks over on the financial planning and tax team is the utilization of donor advised funds to bunch together some of that tax savings. And so we can kind of double end the tax savings by looking at some stocks in the client's portfolio that have these embedded high unrealized capital gains. They can then take some of those positions and donate them to their donor advised funds. And the dollars that are donated to the donor advised fund are then a deduction for them on their tax return, and they get to avoid realizing those capital gains. So they get that double tax savings. And then the great part about a donor advised fund is you get that tax savings in the year that you contribute to the fund itself. And so you could say, how much do I plan to give to charity over the course of the next 5 years, let's say? And let me bunch all of that into this one tax year to offset a different strategy, like taking capital gains within the portfolio, or perhaps a Roth conversion to take a distribution from their IRA. And you get to bunch those all into the same tax year to offset one another and truly create some meaningful tax savings for the client. And then they have that nice fund that is sitting ready for them to donate to their charities over the course of the next couple of years. So these strategies are really thoughtfully employed and put in front of clients as a way to achieve several of their goals at one shot.
That's really great. I think you used the words tangible value add for clients at the top of this conversation, and plenty of examples that you just walked through, which are fantastic. And I know you have more and more, so we'll have to pick this conversation up at another time, I think. Thanks so much, Caitlin, and looking forward to doing this with you again soon.
Yeah, thanks, Carrie. Anytime you want to talk about things, I love to go through the strategies. And it's just so fun to get to put these in place for our clients and see how that they really get to see this impact their financial picture. And so, as always, we're here to talk through how any of these strategies can be used for clients in the future as well.
See you soon.
See you soon.